Right, let us start. So before I start this, I am recommending you, this is going to be one of the strategic diagram or strategic conceptualization. Do this drawing with me. As I said, we are going to break the whole process of auditing into pieces so that you understand the nitty-gritty. So please draw this with me, and as you draw this, it will be very useful for you to connect this to all the areas or balance 5 sessions of your chapters, right? So therefore, you can start with me. So as you know, the whole process of auditing revolves around one thing, that is financial statement. Auditor is going to give an opinion on financial statements, right? So let me to start with financial statements here. So I'll start drawing this because I need a lot of space. I'll start from the top, financial statements, right? And this is a rectangle. There is a meaning for all of this. And if you take set of financial statements, there are 5 things in financial statements as elements. There is no 6. There are only 5. 1, 2, 3, 4, 5. So that is, if you take the balance sheet, there are 3 elements: asset, liability, equity. The other 2 elements are in the income statement, that is income and expenses. So these are the 5 things in set of financial statements. And from audit perspective, we always talk about 3 things in relation to these 5 things. Now I would probably say this session for the next 1 hour is going to be your vocabulary of auditing and the foundation for auditing. Although this lecture, if you take in terms of your understanding, perhaps at the end you will see, I did not fully understand, it's very technical, there are a lot of words that you don't know, but I am saying at least 60% if you understand this lecture. But if some of you are very diligent, keen students, that you will carefully watch, because you see, if you take a house, if the foundation is not stronger, the house is not going to be stronger. So if you learn this 1 hour properly, I am telling you, right, you will probably, that is going to be one of the reasons for your exam success. And you will see all the terms that you are learning at the end of these sessions are there in almost all your key chapters in the study text. And this lecture is definitely going to cover about 40% of your syllabus at a glance in 1 hour. That is the power of this lecture, and that is why I wanted to term this as the heart of auditing, the assertion and audit risk model. So therefore, please draw with me. So these are the 5 things: asset, liability, equity. That's your balance sheet or statement of financial position, and this is income and expenses. Then I said there are three things that we usually these 5 things, when in auditing, whenever we use these 3 words, right? What are those 3 things? Account balances, that is 1. And then classes of transaction, that is, revenue, expenses, etc. Now this is all balances, debtors, creditors, and so on. And the other one is disclosures. These are the 3 things that always in auditing it talks about these 3 things, right? And then the next important thing is the big concept that you are going to learn. So therefore, in this diagram I am writing some in red color. They are very much examinable, and this is a new word for most of you if you are learning auditing for the first time. A very powerful term, that is called assertion, right? I am going to explain to you all of this, and usually I will give a strict mark to these concepts so that you know. I'll give you notes so that you can write those notes. So assertions, right? And then now these assertions, I am writing another term for this assertion for you to remember all the assertion, and that is pack cover. right? So later you will know what pack cover means, and then these are essentially used to discuss the most important concept in auditing, and that is, I am again writing that in red color, that is RMM. RMM means risk of material misstatement, and that is the main objective of an auditor. Now, if you take the objective of an auditor is to express an opinion stating that financial statements are free of material misstatement. So what is the word? Financial statements are free of MM. I use the word MM, material misstatement. And another word is financial statements present fairly. So fair, all of that, you know, are connecting to risk of material misstatement. So the whole process of auditing is auditor to look at set of financial statement. There is a balance called property, plant and equipment. Is there a risk of material misstatement? So that's what we are going to look at. So therefore, some of these concepts that we are going to learn in much detail. So risk of material misstatement, and then I close it here. So now, if I ask you a question, let me to box these things. These are the three things that we are going to talk, and these five things you understand, right? Asset, liability, equity, income and expenses. And like I said, the main objective of audit is to ensure financial statements are free of material misstatements. So the first concept that you need to understand is what is now some people also use this word, so let me to write ROM. Another word, right? Another way of, if you want to remember a risk of material misstatement, ROM. So the first concept that you, so I'm putting a strict mark so that, you know, at the end of this lecture, I want you to make sure that you have learned all these concepts. So the note 1 is risk of material misstatement. So there, the first thing, right, rather than explaining entire risk of material misstatement, I will explain to you what is a misstatement. So let's start our discussion with what is a misstatement, because this talks about ROM. So then let's start with 1M, what is a misstatement, right? So let me to write here misstatement, right? So the misstatement, now this is interesting because if you look at, if somebody will take one, now see this is set of financial statement. Take one asset, that is property, plant and equipment, and in the balance sheet, if auditor were to say that property, plant and equipment is misstated, overstated, right? Let's say the recorded amount is 100 million, recorded amount is 100 million, right? Now, how do I know whether this is overstated? Which means I have to compare 100 million with some other figure. What is that amount? So therefore, misstatement, remember when audit audits, misstatement is recorded, the difference between recorded amount and what should be recorded based on SLFRS. So now we comes to a very important point. You see, in auditing is all about applying SLFRS, right? Misstatement means the difference between recorded amount. Recorded amount means, remember, usually company record amounts based on company's policy, right? Company's accounting policy, right? The recorded amount and what should be recorded. What should be recorded as per what? As per SLFRS. Now in this case, LK 16, property, plant and equipment. Now let us say this is an export company, and let's say their business is they are exporting kitchen equipment. Now with the current economic crisis affected by COVID-19, this company is struggling. They don't have sufficient, they can't import their raw material and they can't export. They have stopped their operation. Now during these periods, now some of these heavy machineries are not in use for several periods, and we know when the assets are not generating sufficient cash, normally the recorded value of an asset, when you learn accounting standard, you know, because you are learning accounting standard at that level, at this level, and that is called carrying value, right? So if there is a difference, now carrying value is 100 million. If you take the impairment standard, you are comparing carrying value with recoverable value, right? Recoverable value. Now asset is impaired means you have to check the recoverable value, right? If you find that the recoverable value after doing the impairment test is 80 million, right? Because these assets are not generating, you have to write off some part of the assets by doing a cash flow forecast for the, you know, that forecast. If you learn the impairment standard, you know that can come if you want to sell this machine now, what is the fair value, or if you want to use it over a period of time, that we call value in use, right? And based on that, I'm not going to complicate with accounting standard now. If you are not thorough with accounting standard, that is going to be a little issue in this subject. So therefore, I recommend you to make sure that you are up to date with accounting standard. Although you are not up to date, don't worry, right? Let's say you are not doing your CL2 financial reporting paper, then you have to take extra care to make sure certain fundamental accounting standards you know, because always misstatement is measured based on company's figure and what should be recorded based on SLFRS. Therefore, I have planned, and you will watch in future one video with all critical SLFRS, how they are going to affect, you know, auditing or the financial statement. So that summary is I'm going to give. But anyway, in here, in this explanation, there is a misstatement of 20 million. So with that, you understand the word misstatement, and there is another M, and that is called material. So the next concept that you should learn is, if I put X2 there, is materiality, right? If you take X2, the next concept is materiality, right? Now that's another important one to study. Now what is materiality? Now I talked to you about a company that is, let's say this is a limited liability listed company. So their main business is exporting kitchen equipment, stainless equipment, you know, etc. Now this company's profit is deteriorating. Investors are worried, and in this context, company is trying to overstate, you know, asset value. They are not going to charge this 20 million to P&L. And the next question, if auditor is going to, before auditor is going to change the auditor's opinion. Remember, auditor is going to give an opinion. So let me write this. Auditor's main purpose is to give an opinion saying that financial statements are free of misstatement, but if there is one misstatement of 20 million, auditor will say, we can't give, right? I can't say financial statements are free of material misstatement because I found one misstatement. Therefore, the question to ask, okay, there is a misstatement, how about the other M? Is it material? So the important concept, whenever you read your chapters and exam question, remember this term materiality. Now in very simple term, materiality means something significant, big amount. That's material, right? Audit is going to change the report. Now in this case, 20 million, if I tell you this 20 million as a percentage of this company's profit is 10% of profit before tax, then I am going to say that this is material, not just because of 10%. Remember this materiality definition we ask in one question. If you are an investor in this company that produces kitchen equipment, various stainless equipment, and you are worried, right, because assets are overstated, if as a result of this 20 million, if you are going to change your economic decision like investing in this company or to sell your shares, and that is material. Therefore, remember, information is material. So I am writing these words, right? If omission right? Omission means something not included in the accounts. Let's say liability is not included. Omission, no misstatement. Now, in this case, it's a misstatement of 20 million. Omission, no misstatement, which is going to affect economic decision. Economic decision of primary financial statement users. That is a new term that you may not even find in your study text, but it's a new, this standard was changed. Now, primary means who are the main people who will review these accounts. They are investors, right? Now, if I am an investor, by looking at this 20 million, I am going to say that I am not investing in this company, and that is material. And remember, when it comes to now here 20 million, this is 10%. So now what matters is the size. If I tell you, no, this is not 10%, I am changing this percentage to 1%, then I might say, okay, 1%, nothing. It's not material for me. So therefore, remember, usually materiality depends on the size, and sometimes it does not depend on the size, it depends on the particular error, that error in the circumstances. Now, in some cases, you find even a small amount. Let's say there is a fraud, right? Now, fraud, even 100,000 is significant. Now, that is why we say materiality. We have to look at not only the size and nature of the error, judge in the particular circumstances. Now, I am using big word. Nature of the error. What is the nature? It looks like it's a fraud, right? Or related party transaction, or that it is 1 million, but if this 1 million is reversed, what happens is profit becomes a loss. Now that 1 million, the nature of the error is such that it is significant. So just note this word, size or nature. Nature means in a situation, in a given situation, it is material. Now this company has only 1 million profit. If you reverse this 1 million, profit becomes a loss, something like that. So that is material. Now you understand that the purpose of auditing is for the auditor to form an opinion stating that financial statements are free of wrong. And now you understand misstatement is the difference between recorded amount and what should be recorded based on the SLFRSs. And you also understand materiality. Now then, I want to connect. When set of financial statements are prepared, remember always management is preparing this set of financial statement based on a FRF. Now what is FRF? Now please write. So let me to write the full word. Otherwise later you will forget or you will struggle to find what this is, right? FRF means financial reporting framework. Now some students don't know these words. When you read in the study pack what is FRF, you lost. Now in simple term, financial reporting framework of Sri Lanka is SLFRSs. Now you understand, right? Set of financial statements are to be prepared based on financial reporting framework. But remember, for your knowledge, there are two types of financial reporting framework. Later, we will discuss this term. These are called advanced learning. Sometimes the concept that we will discuss later also, I am telling now, not to study now itself everything. If you are a very good student, I told you in my initial introduction session, I am not just guiding you to get 50, right? If any one of you want to be the prize winner in this subject, that is possible. Right? That's the assurance that I gave you at the start. Therefore, believe this lecture is foundation for your advanced auditing. Make sure that at the end of this lecture, I'm going to do another additional work. Now, I'm writing a lot of concept. I put here concept 1, and I put here concept 2, right? And then I am putting here concept 3. Now, these may be in several chapters in your book, but in 1 hour or little more than 1 hour, you are going to learn a lot of concepts. And after those stronger knowledge, Because I've told you, if you just go in the order of the chapter, you will get lost, because chapter 1 or chapter 2 talks about assertion. But assertions are actually explained in detail in chapter 7, right? And chapter 4. And that is why without a foundation, you should not enter into a, I don't say difficult subject, into a subject like auditing. So the foundation is critical. So I remind you that. So what I want to say now, some of these words you want to write, later you will learn. Now there are two types of financial reporting framework. One is called fair presentation. The other one is called compliance framework. Now, okay, you will wonder what is this. Now, fair presentation means, right, now that usually SLFRSs are considered as a fair presentation. Why? You know, SLFRSs are not like 100% rule. The fair presentation framework recognized in very rare cases you may deviate from accounting standard. Right? And sometimes company can give information which is beyond the accounting standard, right? So that is a fair presentation framework, right? And compliance framework means you can prepare a set of financial statement based on IRD Act. What is IRD Act? Inland Revenue Act. Now there you can't violate. You have to follow rule to the dot. That type of framework is called compliance framework, right? Now, in any of these framework, when you prepare financial statement, there are 3 things that matter, and I will write those 3 in a little while. Because I want to get to this concept of assertion now, because I explained to you something called risk of material misstatement, right? Actually, what I explained to you, first I explained to you what is a misstatement. I put X1 there, and also I explained to you X2. And I can put a bracket to all of this and write X3. If somebody asks, I'll write X3 also here, right? What is, if somebody asks to explain this full thing called ROM, risk of material misstatement, is there explanation? Yes, I'm going to explain to you that as well, right? But individually I explain to you what is a misstatement, what is material, then together what is ROM, right? Together what is ROM, you should know. Now we are coming to the most important concept, assertions. Now first of all, look up the dictionary for assertion. The word assert, the noun assertion. Now if you look up the dictionary say assert means declare something to be true. That means somebody is saying something to be true. Now I am saying he's really a good guy. I saw him only for 2-3 days. How can I say he's a good guy? I am wrong. Just because I associated him for 2-3 days, I can't say good guy. I have to study his behavior carefully. Later I figure out this is a terrible guy. So assert means somebody forms, somebody declare, now without further study you can't say that assertion is right or wrong. Now therefore, that is from general sense, right? Assert. I assert he's a wonderful guy, right? He asserted that he is correct. We don't know whether he is correct. In court of law, let's say, after evidence we find that he is guilty. Assertion general meaning is that, remember, assertion in set of financial statements means this, right? I use this space here. If I say that there is a set of financial statements and let's say revenue is 900 million, right? Now when they say revenue is 900 million, management or the board of directors assert that if this is an export company that I mentioned to you earlier, this 900 million has all the sales that occurred during the period, and they have not put, now see the word I use, occurred during the period. They have recorded all these sales at the correct value, and there is not a single invoice they have missed. Everything complete, right? This is correct, accurate, complete, right? All of that. So therefore, remember one word for assertion. One word for assertion. There's a longer definition, right? Now in the book. Now this one word also some students just read and they don't understand. Even if you read the book, you don't understand. Now if I tell you the book definition, you go to, I can give you page numbers in a little while. Assertion means a representation by management which are explicit or which are representation by management which are explicit or implicit, right? Embodied in the preparation of financial statements. Now do you understand, right? Assertions are used in preparing financial statement in accordance with SLFRS, and auditor use assertion to identify potential mistakes. If I only tell that, you don't understand, forget that. Again, assertion, the one word that I mentioned to you, remember this, even in MCQ, if you see these words, representation by management. So write that word when we say assertion. I will erase this, I will for the time being write assertion means a representation by management. Then you will again ask me, what is a representation, right? Representation means management just say, okay, if you in a very plain English, just say that. They just say that this sale is totally correct. This is accurate. This has all the sales transaction. This has now every transaction has been recorded. It is recorded at the correct value. All of those putting together, we say, you know, this is what? Representation. They just say that there is no possibility for any error here. Now, when it comes to pack cover, I will explain to you what does this representation means. Okay, in very simple language, I say dictionary says declare to be true. The auditing standard says assertion means a representation by management, right? Which are sometimes explicit. Explicit means it's written in the annual report that, for example, management says no fraud has taken place. Management says assert. Now, rather than I say management say, I can say management assert. Management asserts that all, right, related party transactions are recorded. Now, all means C completeness. I will come to this C completeness. Those are assertions. So, representation by management, sometimes explicit, sometimes they are implied. You don't need to say management. Have you seen in annual report, they say our revenue is accurately recorded price into quantity. They don't say, they are implicit. And then the standard also use this word embodied. Embodied means it's like, you know, in persons, you know, like your blood. It's embedded, it's connected. Okay, now I've said a lot of things, but remember one thing. Assertion means representation by management. When they give set of accounts, now I will come to this word. They say that the sale is accurate. They have only recorded those sales that actually occurred. When I say that, you know, some companies, if you take Satyam, they reported more than 7, Satyam is a software company. They reported more than 7,000 fake invoices. Those sales never happened, they recorded. But here, management says we have only recorded what is actually occurred, and those sales are accurate, and we have recorded all the sales that should be recorded, and that is how this assertion things comes. Now you understand what assertion means, representation by management. So at least that theoretical understanding you have. So I said at the end of this session, I'm going to show you what, because if you have, I'm writing a lot of things here. This is going to be one of the key diagrams. Therefore, I am showing you a document with all this definition and page numbers so that you are very clear, and that is the starting point before you watch all other future videos. I will exactly say this is chapter 1 or 5 or 2, but this is the connecting video, right? Or this is the connecting session, a foundation session. And even this session, if you take very easily, this will cover probably about 40%. I will tell you how this connects to about 40% of your syllabus, so little more even, right? because I have spoken about opinion here, I have spoken about materiality here, and then I am talking about assertions here, etc. Okay, now we can extend this definition. Now you understand what is a risk of material misstatement. Actually, you know what is a misstatement, you know what is material, you know when any account, I took the example of sales, and I am continuing to take this example of sales in this video, right? And also I took one account balance here, PP, right? Now let's say earlier, when management recorded sales as 100 million, that assertion is called valuation. Normally for a balance, there is assertion called V here, valuation. Don't worry, I will again explain to you all this assertion, right? Valuation, management assertion is 100 million, right? But if after auditing, auditor has figured out assertion valuation is wrong, when we say wrong, it is misstated. Why? This company has not impaired, and that is 20 million. And that is how you look at assertions. And now you can write these words, right? I am not writing here because otherwise it will clutter my diagram. And I want you to write this meaning of assertions, and I will explain to you them further, right? Now, what is P, right? Okay, I will write and then I can erase it. Okay, P means presentation. Now, sometimes some companies, now let's say they can set off assert liabilities and show the net things, and that is not acceptable. There is a separate standard. LK is one about the disclosure, and every standard guides, in some ways about disclosure. Then this A means accuracy. Okay, the A means accuracy. And there is one C here. That C, I mentioned to you something called completeness. I am going to explain to you all these things in another 1 to few minutes, right? There is another C, that is cutoff. And then O, I also mentioned to you what is O here, occurrence. And then there is V, I mentioned to you what V is, valuation. And E, existence, and R, right. And remember, when we say R, we usually say R and O, right, for an asset. And if it is a liability, it's called obligation, right, or obligation. So please write, because you have to make sure you are writing in this diagram. And now I am going to give you high level explanation of these assertions. High level explanation, they are very easy. Take the easiest one. Now, in my export company that I mentioned to you, now after this session, in one of the other future sessions you will watch. When I say future, I hope you are watching this video in the order. So there is a video that I am taking an export company called Ridma, and that company is exporting apparel to foreign countries, several countries. Now that case study is one of the, I would say, one of the very critical case study for you to understand the holistic picture of auditing, right? When I say holistic picture, let's use a simple word, big picture. Now even if you take now let's say that I'm talking about that export company, right, what they are doing. So now in Sri Lanka there are many, one of the largest foreign income earner, right, exporting apparel to other countries. So manufacture in Sri Lanka and selling to various countries in Europe, USA and so on. And sometimes these sales are made directly to the goods will take over by forwarder, and then forwarder hand over to vessel, and it goes likewise. So you keep that in mind. And then the main item sales is garments. In that example, I am asking, let's say there is a sale of 900 million. Now I can tell you several things about this 900 million, right? Now I am also using this, please. Okay, I will first of all explain to you all this, and then here I will use a case and explain to you one by one. you understand what presentation means, right? Usually this presentation should be based on the relevant SLFRSs as well as main SLFRS LKs on presentation, right? And then accuracy means transaction has recorded. Now I use the word transaction because accuracy is usually used for a transaction like sale. Sale is accurate means quantity into price is accurately recorded. Completeness is one of the very tough assertions to audit. Now, completeness of revenue 900 means all revenue, all sales that should be recorded have actually been recorded. Now, imagine this 900 million has, if you count number of invoices sent to US or Europe, that is 700 and during the year, 700 not enough, let us say there are 17,450 invoices. The total value is US dollar 900 million, big amount. Now these are number of invoices. If you are an auditor, if I ask you to audit completeness, your idea is not to get a list of these 17,000 which goes for 50 pages and mark one by one and match with the ledger. That is not the completeness. Completeness means I am arguing there should be about 18,000 invoices. There are some invoices missing. How to find that missing invoices? That is the business of completeness. And why I am saying missing, I know that although invoices not booked, when I study the dispatch note, goods have been dispatched and the security seal also there. If goods are dispatched, there are 18,000. Let's assume that dispatch note and invoices are one-to-one matching. If there are 18 dispatch note raised during the financial year, why should I have only 17,000 invoices? There is missing. So please write completeness means what? All transactions that should be recorded have been recorded. Now you will wonder, okay, I am erasing and writing again. So please go to another page and put this note again, because see, accuracy is very easy, you don't need to write. Remember, I am warning you, this is the most, if anybody asks what is the most critical thing in auditing to learn, I would say assertion. Another person will say audit risk, because I am saying assertion. Why? Audit risk is explained always based on the assertion. Without assertion, we can't explain audit risk or audit evidence. Right? So that's why assertions are important. Therefore, this is critical. I am again reminded. So go to your note another page, because I am also giving you a very big exercises. Even now, let's say you missed to write all these notes. At the end of the video, I'll show you a page, and that will show you in my book where is this definition. I want to read and now highlight. Do it now after this video. So completeness means what? I'll write it here. I'm erasing. You go to another page and write. Right? So I'll use another color. Completeness means all transaction that should be recorded. So in my example, 18,000, right? Because I know that there are dispatch notes amounting to 18,000, but invoices less. All transactions that should be recorded have actually been recorded. That is, now you have to don't write it here, please, because I am going to write a lot more here, right? Therefore, I am erasing this. I am telling you in advance, right? But anyway, that's the beauty of if I am doing this in a classroom, and I have seen over the years of lecturing, when I draw certain diagrams like this, and students write, and when I am erasing some of them, I can see they are annoyed, right? Why? Because they can't erase. But now you can stop the video and do whatever you want, right? You can again watch the video. That's the beauty. So that's completeness. Now, cut off, although it looks a big word, very easy. The cutoff means I am taking the same, because I will in a little while give you, because here I want to give you the simple meaning, right? I'll give you a more detailed meaning in a little while. The simple meaning is cutoff transactions recorded in the correct period. So the key word is period. So what is the key word? Period. So now I will erase it because otherwise I will run out of space to write. The balance occurrence is also a very important assertion, right? Now when I say occurrence, I am again writing the word transaction because occurrence is applying. Now when I say transaction, remember there are three things here: account balances, transaction and disclosures. Occurrence means, right? Now this 900 million has no fake invoices like Satyam. Fake invoices means sales never happened but they have booked or recorded. So occurrence means recorded transaction have actually occurred and relevant to the company. Recorded transaction has actually occurred. Now see, that's how you have to interpret occurred. Recorded transaction occurred and relevant or pertain, that is relevant to this company, relevant to the entity, right? That is occurrence. Now how should I know that this 900 million has actually recorded? Now I select a sample and I find that there is one invoice but no evidence of a shipping document. There is no evidence company can prove, although they have internally recorded a sale of 1 million, there is no dispatch note, the goods have not moved, there is no warehouse document. Then I am questioning, you have recorded a sale that has never happened. If I want more evidence, I go to the customer and ask. Customer also says there is no debtor. That is coming to another assertion, existence. Remember, existence is for an asset. Now when it comes to sale, what is the asset? When you sell something, your asset is what? Debtor. Now if there is no actual delivery made to a customer, if only company has recorded fraudulently a sale of 1 million, I cannot have a debtor, therefore there is no existence. So existence means existence of assets or liability. So asset, recorded asset, liability actually exists, that is existence. And let's say if there is no asset in existence, then right. What is the right? Right, I don't have right to collect money, right? Right to collect money. If we didn't make that 1 million sale, let's say sales did not occur, as a result there is no debtor, and then as a result I don't have right to collect. And remember why we call RO? O for obligation. That means company should record only actual liabilities. You know, some companies just provide. Now I'll give you very good. Now if you are very sharp in accounting standard only, you will understand this, right? If company make a provision for machine, or let's say provision for factory, but restructuring cost, or let's say renovation cost. Now provision for renovation, technically that is wrong. That is not a obligation. Remember in LK 37, provision is a liability and you cannot have a liability if you don't have obligation. Provision for, what did I say? Refurbishment, right? I hope I said refurbishment, right? Now refurbishments, you have to repair, renovate, whatever. Now is there a law that says I have to renovate? Is there a contract that is going to tell I should renovate? No, there is no liability. It's not a provision. Reverse the provision. Now you see, that is how what it is going to identify. If you don't reverse the provision, there are going to be M here. That's a misstatement. Now you will be uncomfortable, although I wrote these words. You want to go through what is the exact definition of this assertion. At the end of the video, you go to the page number with my example. You should be easily read this table. There is a table in chapter 7 audit evidence standard that what is the meaning of each of these assertions. But I have covered most of it, but I want to take another explanation to reconfirm that whether you understood this list. So presentation. accuracy, completeness, cutoff, occurrence, and when there is a valuation. I'll take the same example, right? Okay. Here I have already taken. Now when it comes to valuation, please also write like RO. Here also we use valuation stroke allocation. Now allocation means when it comes to PPE, as you know, there is 100 million PP and depreciation. Depreciation is called allocation. What is minus from those assets are called allocation. Now, valuation is usually guided by accounting. Very often there is accounting standard. Now, how did I say in my example of 100 million, actual value of PP should be 80 million. I said it's valuation assertion. Assets and liabilities are valued based on the relevant SLFRSs, valued correctly at the balance sheet date. If I talk about inventory, I said this is a garment company, and if I say that in the balance sheet there is a 50 million worth of stock, of which I know there is 10 million which is not moving, right, which means more than 1 year these 10 million garments are just there in the warehouse. So the inventory standard tells me that this 10 million I can't sell, the value is 0, I can't sell, I have to scrap it. Then I have to write off inventory by 10 million, because the rule when it comes to accounting standard, LK's inventories, that I have to value inventory at cost or NRV, whichever is lower. Now that is the valuation assertion. I hope I have given you a lot of explanation about assertion. So I will erase some of those examples. Why? Otherwise I can't draw this full picture or the big picture of auditing, the session which connects to all. And I also said I am writing this temporarily, and I will also erase the meaning of assertions. And now I am going to extend this meaning in a little detail, and so that it will be easy for me to go to the next explanation as well. When I say extend, please make a note. You can identify assertions. Yeah, I should keep this now. Number of sales transaction, I said company has recorded 17,000, but actually there are 18,000 sales that should be recorded. So I have a question about, I said completeness assertion, right? Now the big point, learning point is that, which I already covered. If you take assertion, what is practically relevant in the exam? The disclosures are not very much exam focused, because disclosure has to be accurate, complete. We can easily say what is more important in the exam is account balances and class of transaction, right? Now if I draw this table here and say that these are account balances, right? Balances, and these are transactions. And let's see, sorry, I have to put this other way again. If you are sorry for that, if I put it this other way, it's easy. If I put transaction first and then account balances AB. Now I take the example of sale, and I said if I am taking the example of sale, 1 million sales that happen, right? Sale of 1 million that happen, and I said the first assertion at a transaction level, I should know whether this sales transaction actually occurred. How do I know? Not only there should be invoice, but there should be a dispatch note. And when there is a 1 million sales at the balance sheet date, I am going to get, in the balance sheet I am going to get a debtor, and as a result debtor is in existence. And when there is actual debtor that is in existence, I have another assertion, that is I have a right to collect, right assertion. Now see occurrence. And then if I also ensure that this sale is quantity into price is accurately valued, and for transaction purpose that is accuracy, right, as a transaction. And also if I know that this transaction happened as at 30th March and it has been recorded at the same date, then I know it is recorded in the March correct accounting period, so cut-off assertion also done, right? Now see this main assertion, and then if I know that this debtor, now let's say this debtor went bankrupt, now I have a problem because I may have to write off this 1 million, I have a credit loss, and that is if I want to write off or impair the debtor, what is the assertion I am talking? The debtor 1 million valuation is not right, that's the valuation assertion. Now usually existence right valuation, these are applicable for account balances, right? So these are balances, right? And these assertions, occurrence, accuracy, cutoff for transaction. Now the one of the big assertion which is applicable to both, let me write here, see here, very tough assertion. What is C? Completeness. Completeness, I said all transactions that should be recorded have actually been recorded. So I'll want to give you an example for completeness assertion as I go through this further, then you will understand what is completeness. Now here you know it is not complete. Why? Because there should be there are 18,000 dispatch note, and if auditor really confirm these sales have been made, then why some invoices are missing? The completeness assertions is out. So now I have given you some basic introduction and of course in little detail also the assertion. Now you understand there is a set of accounts, there are account balances, transaction. You can now use assertion to identify misstatement. Remember there is something missing here. I want to write three things I said. One is assertions are used by the auditor. Now if there is MCQ, what is the use of assertion? By the auditor. Auditor is using assertion to identify potential misstatement. Now auditor can say debtor 1 million to be impaired, the valuation is wrong, and these transactions have never occurred, therefore transaction should be reversed. There is no debtor in existence at the balance sheet date, company does not have a right to collect, and so on, and there are some sales invoices missing. That is how assertions, and as a result there is a misstatement, and if there is a misstatement, audit should see opinion should be changed or not, qualified or modified. We will learn under opinion paragraph. Remember here I am explaining to you what are these. Now I mentioned to you there is note 3. What is FRF? Accounting standard. Remember assertions have to be used by management. In applying accounting standard, there are 3 things when it comes to accounting standard, right? Management has to use assertions in recognition. Now you know every accounting standard you come across this word. Recognition, right? A measurement, right? And disclosures. Now this is the marriage between what? Marriage between what? Accounting standard. This is all about SLFRSs, right? Marriage between SLFRS, and this is all about, assertions are all about what? Sri Lanka auditing standards. Right now, recognition means should I record the sale? Right? So there is a accounting standard, SLFRS 15, revenue has to be recorded. Right, when company has actually discharged. Now if you don't know accounting standard, you will struggle, right? Revenue recognition standard says when the performance obligation, when my duty is discharged, my duty is done, then only I can recognize the revenue, right? So the performance obligation, recognition, and then measurement, at what amount should I recognize the revenue, accuracy, valuation. See, the measurement is connected, and then the disclosure is there. So assertions are also used by the management in recognition, measurement, and disclosure. So now that now I'm coming to a very, very important part in this diagram, right? That is, I will put I'll just I want to draw one big circle in red color here, and let me to remove what is written on the top. And remember, this circle is going to be a major learning and major concept that we will come across. So there is a big circle here, right? And also I am going to take this RMM out and to say that there are two types of RMM, right? If you know, for MCQ question, what are the two types of RMM? One is here, and that is called inherent risk. So then what is inherent risk? Now, very, very important. Now if you look at our notes, and I have put some notes here, 1, 2, 3, and if it is 3, this should be 4. And then I will write here note 5, what is the inherent risk? It's very important, and you will understand in a while why I am now only coming to inherent risk. Now there is a word called risk of material misstatement here. There are two types of risk of misstatement. Before I am drawing this diagram, I am telling you one is an inherent risk, the other one is control risk. You may already know that, but at the end of this video you will understand to what level you actually knew, and that may be incomplete, right? So what I want to say, when you say inherent risk, now these risks we can divide one part of that as inherent risk. The inherent risk is, I will again read a book definition to see whether you understand. Inherent risk means what? Susceptibility that an assertion can be misstated. Now see, the word assertion comes. Now if anybody read this definition, I will read it again. Susceptible, now you don't know what is susceptible. Susceptibility looks like a big word, but very simple. Susceptibility means, let me to write here so that you understand, right? But this thing I write and erase. You can also go to your note and write. So inherent risk means susceptibility that an assertion can be misstated. Now see, if you don't know assertion, you can't read this. Susceptibility means simply you can write possibility that an assertion can be misstated, but there is another part in this definition which is important. So I write in different color, susceptibility that an assertion can be misstated without considering control. That is very important, without considering internal control. Now then you will understand in a little while what this means. I'll take example. What is the possibility that an assertion can be misstated, right? Without control is the book definition. First of all, like we learned the word assertion, literally means dictionary meaning. What is the dictionary meaning of inherent risk? Inherent, the word inherent, it's there, you can't avoid. If you are living close to the sea, there is possibility of things like the exposure to tsunami is high. If you are living close to sea, there is an inherent risk of such exposure, right? And if somebody asks, I can take an interesting example for inherent risk, right? Inherent risk. Take COVID. The possibility of getting infected, inherently high, because where now I am, in this case I am not using a mask, right? But if I go out to a public place or a wedding, the possibility, inherent risk means I am saying what is the possibility of COVID infection is very, inherent risk is very high. Whether I have a mask or not, inherent risk means you are telling, usually if I take diabetes or something else, there is no inherent risk like that. That depends on many other factors. So the inherent risk means by nature that is complicated, that is difficult, that is inherent risk. That is why possibility that an assertion can be misstated, don't worry whether you are controlling or not. Whether I have a mask or not, irrelevant. What is the chance of COVID infection? Generally high, right? Now then whether mask is okay or not is a different matter. So therefore remember, in inherent risk definition we don't take control into account. Why? We want to account. Auditing standard says there is auditing standard for all of this, and that is a very fundamental auditing standard. I'll write this name also, auditing standard number 315. right? So when it comes to inherent risks, we don't look at control. Why? We want to assess, measure inherent risk without control, because control risk will come separately. I will write it somewhere here. Now you understand what is inherent risk. I will erase this definition, you can write it, and I'll take examples so that you understand it very well, right? So this is very important. Next 10-15 minutes explanation is going to be very important, right? Okay, inherent risk. Now I go back to my export company. This will come to you as a case study later, IDMA PLC case study. Now the export company that I mentioned to you, I will also use this side of the board so that I can utilize the space properly. There is an export company called RIDMA, and then there are revenue. I am talking about, see, one transaction, that is sale, not one, I am talking about sales. And now you need to understand, doing an audit means you have to assess the risk before you audit in. Otherwise you are just blind and auditing whatever, whatever you think important, you audit, right? But auditing standard says you go and audit the big ticket items where things can go wrong, rather than auditing little things. That's why you have to audit material things which are important, high risk. Now I take the example of revenue recognition of this company, one of the company, right? I mentioned to you in the name RIDMA because I'm going to give this case study so that this is the big picture main session and you will be able to connect this. If I am talking revenue recognition and this company, and this, let's say this is the factory, and then from this factory, how sales are made. Sometimes, when the goods are going, okay, they raise an invoice. At the time of raising the invoice, your general ledger is updated, and then similarly at the same time they may do the dispatch, we don't know. So there is a dispatch point. Now dispatch means goods going out. Now see, these goods are normally very often given to a carrier. There are forwarding companies, right? So we will say handover. HO means handover to forwarder, right? And then after that, goods should be on the vessel, right? Vessel, and goods are sailing. I can row a vessel and it's sailing, right? You can say goods has to sail. But for your purpose, remember this documentation is very important. Now when there is a dispatch, there is a dispatch note, and then when goods are handed over to a forwarder, there is a forwarder note, forwarder acknowledgement or forwarder note, let's say. And remember, if it is goods are on the vessel, at that point there is a document raised, and that is called bill of lading. Very important document in international trade, BLL, right? Bill of lading. What I want to say now, there are sales that has taken place, and this company has several customers, right? Say if you take main customers in some customers in US, the shipping terms, we call this international commercial terms. Some customer shipping terms is FOB, which means when the goods are on the vessel, only you can recognize revenue. And that is where, according to the standard, if you apply, because I told you Mr. Statement means you have to apply the relevant SLFRS. SLFRS 15 says revenue has to be recognized when the control has passed. Earlier regime is risk and control. When the risk and rewards are passed, but the new standard says at the point at which control is passed. The standard has 5-step process in revenue recognition. Now I am scaring you because you have to know accounting standard. So there is a 5 steps process of revenue recognition under SLFRS 15. There has to be a contract, then you have to determine the price, performance obligation, allocate all of that. But what real point for revenue recognition is The point at which control pass. So the control pass depends if it is a 4B contract at the bill of lading date. And there is another contract when you hand over goods to forwarder. Those contracts are called, now these terms you should have learned even in your previous auditing paper. These are basic things you should know. FCA contract, right? That is where goods are handing over to a forwarder. And then I will also tell some shipment term says ex-factory. Ex-factory means the moment goods are going from your factory, you can record the revenue. So that is a dispatch note point. Now if I tell you, as at 31st March, this company has recorded 10 million invoice, and if you really look at that 10 million invoice, the shipping term is FOB, but they have booked this 10 million as a part of, I mentioned to you 900 million revenue, there is 10 million they have booked as at 31st March. Now, can they record this as 31st March? Remember, 31st March is only the invoice date. And you may also find goods are dispatched 31st March and given to the forwarder on 2nd April, because forwarder has come only 2nd April and this vessel is actually sailing on 10th April. Can we record the sales in the month of 31st March? No, the shipping term is FOB and I said it's a 4B contract. Sale can only be recognized based on the bill of lading, that is April. Therefore, there is a cut-off risk, right? So, cut-off risk. See what assertion is wrong? Cut-off. Why I took this example? Now imagine this company has several contractual terms like CIF, and then revenue recognition is not simple, it is complicated because there are multiple elements of multiple terms. Because there are multiple terms, unless somebody is comparing every invoice with the shipping documents. I write the word because these are called shipping documents. Unless somebody compare invoices with shipping documents, they are not able to, correctly recognize revenue, and that is what I want to say. Therefore, in this company, there is an inherent risk. Revenue may be misstated. Now, remember what inherent risk means. Possibility that an assertion, in my example, cut off, right? Possibility that an assertion can be misstated whether they have a control or not. There is a high possibility. Why? That is because of one thing called complexity. So therefore, when you want to discuss whether there is inherent risk, I use this word tukums. There are 5 features. Even in exam question, you can remember these 5 things, and very easy when you are doing a case study. If any one of these are there, you can say there is, inherent risk. So what are those? 1 is complexity, 2 is complexity, there is another C I will explain to you, change, and then 2C is U is uncertainty, and then M, please write that M I am writing management bias, right within bracket there is a fraud risk in a company, that is an inherent risk, and then some balances are subjectivity. When these are there, we usually say inherent risk is high. Now in my example, you can easily write, if there is an exam question given this case study, you will write one answer, you will write in the exam. If examiner says identify risk, you will write there is a possibility, right, that sales cutoff may be misstated because one word, the word is complexity. Why? Company has multiple. Now what? Multiple shipping terms. Therefore, each invoices need to be compared and then only you have to recognize revenue. Therefore, it's complex. Right? So, I don't explain to you all of other things now because this is our first session, right? But I will explain to you a few of them in detail, but I take this as a main one, complexity. But let me to quickly tell you what others also means. The change Now this change is usually in some businesses there are a lot of changes that is happening, right? Now there are new customers that are happening and they are going to e-business suddenly. Now see, all this is there, but they suddenly started selling via website. Then at what point they have to reckon now the website is a change. Now usually, let me to write here, now see what is in the accounts are result of business decisions. Now what should be on the top is business objectives. Every business has business objectives, right? Now business objectives to maximize the revenue, and they are going for a digital business model, and that is a change. And remember, usually these type of changes we call business risk, right? So what I want to say now, please write my example. One of the business risks is change into e-commerce. Now when there is a change, business risk means those risks which are inherent in the business, but in auditing standard there is a definition to say business risk arises from the change. Like I said, companies going now. COVID is a change in the business world, right? Change. Action by the company or inaction or inappropriate strategy, business fail, those are business risks, right? Now these business risks also come in and affect in, now especially this change. And some businesses are, inherently complex, the complexity comes. Now good example, if you remember, there's a company, there was, Touchwood. Once it was a very leading company. See, Touchwood is all about, very complicated business. And as a result, now valuation of biological asset, all of that is complex. Biological asset tree valuation, right? Now, similarly, at inherent risk, we will see uncertain. Now, say there is a legal case where settlement is not sure. Inherent risk is very high. Management bias comes, whenever there is a chance of fraud. This company, the managers are getting bonus based on the sales target. That is why they are changing the sales. And those, if you identify things like targets, commissions, and those are fraud risks. And especially subjectivity comes, right? Subjectivity as well as uncertainty both can come in accounting imbalances where there is a fair valuation. Fair valuation is a very complicated thing. You would have heard about financial instrument, derivatives, investment property valuation based on discounted cash flow, all these various methods, share-based payment valuation. These are usually fair value and estimates. Even my example of impairment, these are what? Very subjective, and also there is uncertainty. Now whenever these words, even in the exam you can use these words to explain inherent risk. Now I want to get to another important point. That is, I am taking my example. Let me to write my example. Now in this case, I am writing my example, so which means I am identifying a risk. Right, I am identifying a risk of misstatement. I am identifying a risk of material misstatement. Now see, in the exam question also like this, you will write. So my risk of misstatement is, right, there is a possibility of misstatement of revenue due to complexity. So why there is a complexity arising from multiple shipping contracts. Shipping terms, multiple shipping terms. Within bracket we can say FOB contract, FCA contract, Annex factory, and so on. So now there is a risk. Remember, when there is a risk, company will not sleep, because company CFO knows that the revenue can go wrong if they don't match each invoices with the relevant shipping terms. Therefore, there is a circle here, and that circle is what? Let me to use another black color. That circle is how company is going to protect against the risk, and that is called control activities. You know, companies can have control. For the simplicity, you can say it's control activities. I want to give you several examples of control activities, and the meaning I'll write within the circle itself this word control activities, control activities, because I want to write, okay, what are the controls that company can have in this case, right? Let me to use another color. There are several controls company can put in place to ensure that they will record revenue properly. Now these are control activities. I'll write about 4 control activities so you understand. Now before I write 4, you have to tell me that if company wants to avoid this risk of, you know, this 31st March sale, you know, if you only look at the invoice, okay, there is 10 million, but if you compare the invoice with the bill of lading, you can't record it. Cutoff is wrong, and this type of control is called reconciliation. Now these are the control. Reconciliation. I'll write other control meaning, please write with me. If somebody asks what is the heart of control, the answer that I am going to give SOD. And if you look at, especially in your chapter 2, chapter 3, you will see SOD is everywhere. What is SOD? Imagine in this company there is only one man who can dispatch, who can invoice, who can collect money, he can do anything. And you know, a lot of frauds can happen. That is where we say there has to be a segregation of duty when it comes to authorization, recording of transaction, and custody, right? So that is segregation of duties, a control activity. Reconciliation, right? And then there should be physical control to ensure, now this finished garment, we have to ensure nobody will steal. The physically protected assets are protected. And another important control is authorization. Now to make sure all the sales, only genuine sales are recorded, every sale invoice or should be authorized by the manager, and these are called control activities. Now see the word control activities, and sometimes management will go through various sales report to make sure sales are okay. Those are called business performance review. All this word you will come across when you read your chapters. Business performance review. Right? Now there is a control. Another point that I want to tell you, now in this company, now there is accountant who is supposed to compare, his job is to compare, to reconcile, right? Reconciliation is also comparison. Compare invoice date with shipping documents. Shipping document is bill of lading. Now we recognize that, you know, sometimes this accountant is not doing this or taking a wrong report and doing this, which means although we see there is a reconciliation, either we are going to say this reconciliation is, you know, it's wrong. By designing, the reports are wrong. Therefore, now note this word, when it comes to a control, we have 3 things to check. Then only this circle is really protecting against inherent risk. Control is designed properly. Control has to be designed and it has to be implemented, right? And then it has to work continuously, and that's called operating effectively. Operating effectively. Now I told you 3 things about a control. Now what is the control we are talking about? A reconciliation. Right now, okay, before this example, later I'll explain to you this in more detail. I said at the start, this you will understand 60% of this video better. This is going to you know, activate your curiosity and to learn more in next few videos in depth, right? So what I want to say, when it comes to control, now see this warehouse, there is a lock. Now although there is a lock, anybody can break the lock, and by design the lock doesn't work, ineffective, right? And then there is a good lock now, but the door is not locked, control is not implemented. Operating effectively means every day this has to work. Now although there is a good lock, some days door is open, it is not operating effectively. So these 3 concepts also remember. The purpose of this lecture is at the end to know the audit vocabulary concepts and you understand broadly, maybe 60%, but as you go through the chapter in detail in future, all other sessions, you can refer back to this session and make sure you will feel that you really understand. Because without such an introduction, if I just do something, you will not get the essence. So therefore, you may watch this video for several times so that you understand all this concept and write in a piece of paper. I'll also show that paper to you, that concept that you learn from this session. So control has to design in place. Now, this accountant, sometimes he has downloaded wrong dispatch note, wrong bill of lading. That means by design is failing. And some months he has not done the reconciliation. Right? It's not operating effectively, which means now we are saying, although there is a circle, the circle is breaking and leaking and there is another risk created, and that risk is called control risk. So the control risk is what then? Control risk means risk that an misstatement at assertion level, again the word assertion level, right, will not be three things: prevented, corrected, detected or corrected by control. Right? Okay, there is a definition you can read. I'll show you the definition, but get the message. Control, the lock cannot handle the risk. Which means if there is a control, the control should be able to prevent the wrong sales. If there is a problem, detect it. If 1 million is detected, correct it. So preventive, detective, corrective, the control doesn't work, and that is control. So now you have learned what? So let me write here. You have now learned assertion level risk. Now if you have learned, if you take, I mentioned to you, when it comes to a ROM, risk of material misstatement, remember there are two big classification, that is, one is called financial statement level risk. This we didn't come yet, it will come very soon. The other one is assertion level risk. So assertion level risk we learn as inherent risk and control risk. Now if I ask you, now this export company, we talked about revenue, we talked about debtors, right? We are taking one by one because we spoke about cut-off assertion at account balance level. But if I tell you the managing director of this company is a corrupted one and he is asking, you know, we haven't hit our budgeted revenue of 900 million. And the managing director is telling the accountant, you know, Puta, you are a young accountant, you know how to cook. Not cook is not a nice word. Managing director says, you know, you are a young qualified accountant, can you help me? You know, some of those provisions can't be reversed. You know, managing director is influencing. You know, it's a nice talk, but later if you say no, you realize that, you know, your other boss comes, CFO comes and say, yesterday you promised managing director to do this. You haven't promised, you haven't given any word. He is very unhappy. Managing director wants you to cook the books, manipulate. If you don't do, you are going to lose the job. And if you are working in such a company, that is the biggest danger, and those risks are called financial statement level risk. And I am writing here what financial statement level risk. I will give you some example. Before that, please write here financial statement level risk means those risks. Remember one word, which are, what is that one word? Pervasive. Pervasive. I will explain after writing this. Pervasive. Those risks which are pervasive. As a result, many assertion can be affected. Many assertion. So I underline the word many assertion can be affected. Now first of all, what is the dictionary meaning of pervasive? Pervasive means many, you know, it's not one, there are a lot of problems. It's a pervasive problem in this company. right, those risks which are pervasive as a result, many assertion. Now earlier we knew because of that sales issue only cut-off assertion can be misstated. But now if managing director is, a corrupted guy, and who is influencing unethically everybody, now anything in the account set he can change, he can influence the accountant, assistant accountant or CFO, anybody, and therefore those issues are called financial statement level risk. So I am writing in red color some example for financial statement risk, right? Please write this example. One is if there is an issue with management honesty, that's why I use the word corrupted in simple language, but in auditing language it's called integrity, management integrity. If there is an issue with management integrity, disaster, that's the biggest thing. And then management can bypass control, that in auditing we use. Now let's say there is a credit term, managing director says, no, my son's company credit limit is, forget any amount you can sell to my son. So you bypass, the bypass means management override control. And also you find that in this company there are people who are not qualified accountant, managing director doesn't want to recruit any qualified accountant, let's say, which means you have a question about management competence. Competence means they are skill, qualification, skill, experience. If they don't have experience, how are they going to account for difficult balances like financial instrument derivatives? So it can be misstated. Right, another example, if I want to give going concern, right, it can affect many assertions. Now, these risks are called financial statement level risk. Right, now you have learned that as well. Now, in this lecture, before I finish, I want to connect this to a much bigger concept to conclude this, right, that is, now I have drawn a big circle and you should ask me, what is this circle? And remember, in a little while, I am going to introduce to you something very big, and that is internal control framework of a company should consist of 5 things, right? And there, one is here. I am putting number 1 here, 1. And then I want you to guess what are these. If this entire circle is 1, and then the next one is out of that circle, and there is a process here called RMM, and that I am putting number 2. Then what is 2? And then I can write number 3 here, right? And then I can also write, now see, in every company the numbers won't just come, no. Now either there is accounting package or a ERP system, let's say this box is that. So then I put number 4 in this box, and then where is number 5? Okay, number 5, for me to write number 5, what I am doing is, I am going to draw another circle around all these 3 circles, and that is like protecting or checking all these things, right? So that is, if there is a circle like this which goes all around, right, and I can put here number 5, and what are these 5? And remember, this is, we are getting to another important concept. Please write. Now if you look at chapter 2 of your syllabus, talks about internal control framework in a company. In every company. Now actually we are looking in this up to now in my explanation, more than the auditor, you are looking company. If you take risk of material misstatement, it's not auditor's problem. Before you audit, you understand, right, the possibility that the financial statements can be misstated due to an inherent risk or control risk. That gives us the definition of ROM. I told you I am going to give the full definition of ROM here, and I said that is note number 3. So please write. Now ROM definition is what? ROM means, I hope you will go back to your note page, right? The risk that Risk that, so let me write, see these are notes that I will erase, therefore please quickly write. ROM means the full word ROM, right? The risk that financial statements can be misstated prior to the audit. Now the key word to underline is that prior to the audit. Now why we say prior to the audit? Now that is where before an auditor starts the audit, auditor has to assess what is the inherent risk in revenue recognition. Inherent risk is high. Is there a control, right? So IR is high. Is there a control? Let's say control is failing. So control risk also high, which means both inherent and control risk is high. If both risks are high, auditor has to make sure auditor will detect misstatement. So I will explain that point also to you in a little while. But now I covered this ROM part, what I was explaining to you previously. Let me to get back to my previous point. In this diagram, the 5 things that I wanted to tell you, in every company, they will make sure any company will have these 3. This is an international framework that you are going to learn. This is called COSO framework. There are 3 things as the objective of every company, and there are 5 things. I told you there are 5 things in my diagram already. I haven't written the name, and this is applicable. Let's say this is a company, they have several branches. Now let's say this is a company like John Keel's, they have hotel sector, they have plantation, various other business units, right, travel agents. Now this framework is applicable to all. Every company, they want to ensure, every company is doing operation, they have to ensure they are effective. So let me to write, use another color, effective and efficient. They are effective and efficient. Efficient means cost efficient, right? Effective means they are achieving the targets in their operation. If you take a tour operation, they are very efficient and their customers are happy, that's operation. And then every company has to make sure the reports they are giving. Here we are talking about financial statement, therefore reliability of reporting, reliability of financial statements, the second objective. Third objective is compliance with laws and regulation. If you take a banks, they have to comply with law, not only bank, every company. So remember, if you are talking about a control framework that can protect the company, what matters to us is not this reconciliation. If you look at most of the corporate failures around the world, like Enron, WorldCom, Satyam, all of that, and in Sri Lanka, the Golden Key, Selinco Group, all of this, Premuka, CIFL, in most companies, was it due to a reconciliation issue, or was it due to something bigger that connects with the leadership and board, right? That is the issue, and that is circle 1, and that is a big concept that you are learning, and I will write that here. That is called control environment. So this is an extremely important examinable topic. Control environment. Another word, whenever there is a control environment, we call tone at the top, which means the top people are doing the right thing and they are always ethical, and if they are ethical, the chances that numbers are right is high. So therefore, in the internal control framework, the first thing that comes is control environment. And this is very much examinable, and I would like to give you this. Remember this word. If somebody asks, okay, what does control environment means? What should come to your mind? Wow, if you are working for a company where all board of directors are very much honest and they pay customers on time, they produce quality products in the accounts, they never cheat auditors, very good. And in terms of governance, they are very active. They recruit only high qualified accountants. HR policies are brilliant. There are segregation of duties, authority, responsibility defined. right? The management is very careful in taking risks. That is their philosophy. I am using now several words. Let me to put all this in one term that you can remember, and that is I call CHAMPIO, right? Now this will be very easy because all the students, sometimes while you are given the opportunity to use open book in an online exam, usually this is not an open book examination usually, right? Now CHAMPIO means what control environment? Now, I mentioned it's about integrity and ethics, whether company is honest. See, integrity and ethical values of business leaders, now, that is one. And then I mentioned to you this company should have qualified people. Now please write that word. To have qualified people we call commitment to competence. Now this is there in your study text. This with page numbers I'll show you. And also if company has a very good culture, right, a very good set of accounts, and that is a result of people in the company, and that is we call HR, right, HR policies and procedures, right. And then there is M here. That M refers to management philosophy. I use this word, management philosophy and operating style. So don't worry that you will not understand this full detail now, but if you go to my video, there is a separate case study explanation about control environment, you can understand. But then why I am doing now also I am explaining to you. Management philosophy and operating style means company is really careful when it comes to risk taking. If there is a company, they always change auditors, they are very aggressive, they invest and make losses. The management philosophy and operating style is really negative. So please write other P, that is called participation. Now let me write that P here, otherwise I can't write the full word. P, participation by those charged with governance. Now when you watch this video, you will see why I write TCWG. Now these are famous words in auditing, right? Those charged with governance. Please write the full word. Participation by those charged with governance means it refers to corporate governance. So control environment as governance. Participation means whether this company has non-executive directors who are independent from management. Independent non-executive directors, are they active? Are they attending to meeting and challenging the management? And that is called participation by those charged with management, out of CHAMPIO, right? So what is A? Now A refers to assignment. Let me again write that A here. A refers to, please write, assignment of authority and responsibility, right? Assignment of authority. Now we know the authority for accounts given to CFO, and CFO has delegated assignment of authority and responsibility. Now we know there is a finance director, overall responsibility, right? And then the authority has been given to CFO, delegated. Now finance director will delegate. Company has very clearly defined this, right? And that all duties, responsibilities are defined in organization structure, which is very clear, and duties are segregated. There is organization structure. If you take finance organization structure, it comes with finance director, then CFO, then there is a senior accountant, then there are accountants for different categories, PP and so on. So likewise, see, now I took 5 minutes just trying to give you a picture of control environment. But remember, in the exam in MCQ, if examiner asks you, what is the control environment? The answer that you have to give. Now, I have only explained to you one, and that is this circle, control environment. If they ask in MCQ, what is control environment? Remember, control environment refers to, right, control environment, I said one word is shown at the top. In addition, control environment refers to those, right? I am putting AAA to introduce control environment, attitude, awareness and action of of management and the board regarding internal controls and their importance, right? Now I will read it again. What is control environment? Control environment refers to AAA: attitude, awareness and actions of the board and management regarding all these internal controls, reconciliation, authorization, all of this, the internal controls, and that is called control. I'm sure still you don't understand, some of you. If I tell you, you are working for a company where control environment is stronger, their attitude towards accountants very high. They take always qualified people, right? They give them software is upgraded and change and all the controls they are introducing, right? There is a positive attitude. Their awareness about accounting and internal controls are very high. When I say they are the even board of directors, right? Remember, control environment, something relating to board and senior management. Their attitude, awareness, and if anybody violate controls, even a CEO who is not following company's control, the guy is going to be sacked. And that is control environment. So which means the board and management consider, in very simple term, internal controls are important. Let me to tell that definition again. Control environment means, right, the governance and the management, attitude, awareness and actions regarding the internal controls and their importance. Now you learn that. Then when there is a good tone at the top, if your main objective is this, let's say now we are talking about financial statement which is in the middle, and secondly, whether company has a process of risk assessment, right? Risk assessment, RISK, risk, and in my diagram, this process is the called risk assessment. Now, if you remember my example, that company has identified revenue recognition is a complex balance. If the same company has investment property or financial instrument, the CFO knows these are also my risk, and CFO will ensure controls are in place, and that risk assessment, I put number 2 here, that is risk assessment. And when there are risks, as I told you, company will implement control activities, and this circle is control activities here. It's already written. And then I said, in a company, this information has to come out from a reliable information system. It's very important that we ensure that financial statements are coming out from a reliable information system. So this box, I put number 4 here, information system. Remember, when we talk about IT system, there is a separate, in chapter 3 you will learn that if system, now if the system has program issue, access rights are not restricted, there are errors, right? All of this, if there are such issues, then we can't rely on this information system. When we talked about information system, we are talking about 2 golden concepts. One is ITGC, IT General Control, plus IT Application Control, right? Now, IT General Control means there are no programming errors. Nobody can unauthorizedly access database and delete. Now, when system is protected, then only we can rely on system-based control. For example, in some companies, when customer exceeds the credit limit, system blocks it. But the programmer goes and manipulates this logic. So that programmer manipulation is ITGC. As a result, my credit limit check has gone for a sec, it doesn't work. So these topics we will discuss in chapter 2 in detail, information system. But remember that without information system, we can't talk about internal control. Information system is how financial statements are produced, and communication. The last one is called monitoring. Now, what is monitoring? The idea is, remember, I put an overall circle covering everything, and that circle is monitoring. Monitoring means somebody in the organization is checking whether these all controls like control environment, the risk assessment, and then control activities, information system, all these are working properly and giving assurance to board, and that is monitoring. Remember, usually in companies monitoring is done by internal audit, and therefore here with the last circle is monitoring, right? So monitoring is there, means internal audit is checking whether these controls, the reconciliations are working and so on. And if I put another one more circle after this, and that is probably external auditing. Now you can see, I mentioned to you at the start of this lecture, right? This is going to be the most important session. This connects, the heart of auditing connects to all other sub-sessions that I am doing, and I said this is going to be a bigger part of your syllabus. Why? The reason is this. If you take in your syllabus, the first part, internal controls, right? You have about 10% weightage. What are internal controls? The internal control chapter 2 is covering this entire thing. So once you learn chapter 2, you will also learn internal controls in specific areas in chapter 3. When I say specific areas, you should know internal control in sales process, like I said, the reconciliation, payroll process, right? And then procurement likewise, that's chapter 3. And then your syllabus has 15% weightage on risk assessment and audit planning, and that is chapter 4, 5, 6, critical chapters. And if you don't know these chapters, there is another 20% weightage on audit evidence. The audit evidence is always connected to risk assessment. And where in this session I talked about risk assessment, that is actually this part, risk assessment is discussed in chapter 4. This explanation that I gave you about inherent, all this assertion, everything, especially inherent risk control, this is chapter 4. And then especially the assertion and auditing evidence, that's connected to, I said, chapter 7, that is audit evidence. Audit evidence is 20%. Now you see here itself, this is 25, 45, right? So chapter 7 talks about these assertions, right? So therefore this is going to be fundamental, foundational discussion. And I said, if you haven't 100% understood this video, be happy, be curious, because you are going to go to each of those sessions and refer back to this and study those concepts. So therefore, I want to tell you one more promise that I gave you in this video, right? I said you have learned several concepts, right? Say, if I put here, what did you learn at the end, taking about 2-hour lecture, right? What did you learn? You will ask, okay, what did I learn? You learned the heart of auditing, all these concepts, right? Starting from what? What is ROM, risk of material missystem, all this, the MCQs, case studies, all of that can come, right? ROM. And then what is a misstatement, right? And then what is materiality, and then what is assertion, and then what is inherent risk and control risk, and then what are the 5 components of internal controls, and then most powerful concept, control environment. Therefore, before I conclude, right, I said this whole analysis talks about 2 big parts of, okay, let me write on the top, whatever I explained to you, if you remember my example of sales, we spoke about inherent risk. We said inherent risk is high, and we talk about that reconciliation as a control risk. Let's say control risk also high, which means overall ROM is high. And that means we know ROM is something auditor will assess prior to the audit. Prior to the audit, auditor knows that the sales may be misstated. Therefore, overall audit risk has another component, and using that component only auditor can reduce the overall risk, and that component is called detection risk. The idea in this company, if you take my sales cutoff example, that there is a risk of sales cutoff. Sales can go wrong, it is complicated, company's reconciliation is not working, both risks are high. As a result, auditor should plan auditor's substantive testing, which means those testing conducted by auditor to detect misstatement, right? Auditor should be able to detect this misstatement. Therefore, if there is MCQ given when IR and CR both are high, auditor's detection risk should be low, then only auditor can reduce the overall audit risk. Then you will ask me, what is audit risk? Overall audit risk means, remember I said, auditor is going to give an opinion. The audit risk there means the risk that auditor gives a wrong opinion when the financial statements are materially misstated. So that is called audit risk. Now you also understand at the end, I have covered the audit risk model that has IR, CR and DR. And remember, DR is something controlled by the auditor, right? And then the last point that I want to make in this lecture, which is very important, sharp point, and remember that point. What auditor is actually doing in an audit? Say RIDMA PLC case study you will get. Auditors, through auditors understanding, auditor understood there is a possibility of sales cutoff. Now, how many sales invoices that I have to check every month whether the shipping documents are tallying or not? It's hassle. Therefore, when there is a risk, always auditor's first choice is to see whether company has a control. Remember my circle here, right? If company has a control, the first thing auditor will check, test is company's control, test of control, that is called test of control. If company has a control to detect misstatement, I am going to see whether company is detecting misstatement. That is in auditing called test of control, right? And then if control is not working, then auditor will have to perform auditor's own procedures to detect. And that is the big point. So therefore, in your chapter 7, you are talking about audit evidence. Audit evidence is usually gathered through two big, audit evidence process, which we will cover in chapter 7. Is all about doing an audit, is all about first you go and figure out where is the risk through RAP. RAP is called risk assessment procedure. Like we did here, sales cutoff, we identify the risk. If there is a risk, decide how are you going to do, how are you going to detect it. Before you giving the opinion, what are you going to do? After risk assessment procedure, auditor will do what is FAP. Please write FAP is further audit procedures. Further audit procedures, right? Now that sales cutoff risk was identified, auditor's further audit procedure is either to test the reconciliation, which we call test of control, or auditor to perform auditor's own substantive testing. Now, even if you don't understand my last explanation, be happy that you are going to learn this. Only learn that audit evidence has two parts. One is to know where are the risks. The other one is to know what are we going to do with the risk. Am I happy with company's control so I can test the reconciliation? If I am unhappy, I am going to compare all these sales, not all, audit is doing on a sample basis, that we will learn in chapter 1, why audit is only providing a reasonable assurance. If I am not happy with company's control, I will do reconciliation by myself by picking a sample of, now you are doing cutoff testing as substantive, which means you will select a sample of sales invoices and then you will go to the contract and see whether this is a FOB contract, and then for your sample you will check the bill of lading. Bill of lading invoice 31st March, bill of lading is April, you are saying this revenue recognition is wrong. So I am sure this session you may want to watch again because this is foundational, the list of concepts you learn, and it has connected from chapter 1 to probably chapter 7. So all these chapters in a logical order you will watch, and also I will publish a document, Word document, that has all these concepts learned in session 1. So with that, we bring this session to a closure, and I hope you will connect. As I said, this is heart of auditing, and this heart you have to connect to other parts so that the entire body works and you also learn the whole picture of auditing. And remember, I mentioned to you a case study called RIDMA. In this case study, most of these things that we discuss you can practically do, and you can see how to write an answer, and by that way, if you practice, you should be able to answer any question. As I promise in that longer session, that you will wonder, okay, maybe some handwritings were not clear and you couldn't write it. So what is the tangible results of the lecture? And that is, I would say, audit vocabulary as well as when I say vocabulary, when you are writing an answer, remember you have to use these words. And when you read a chapter, you can very quickly read if you understand this concept. So therefore, whatever we covered here, I have summarized. If you remember, those notes that I wrote, I mentioned this Learn the Heart of Auditing Big Picture session, a risk of misstatement, and now you can see from where this comes with the page reference, right? Risk of misstatement, I said ROM is the risk that financial statements are misstated prior to the audit, right? Now, why we say prior to the audit? Because this is something that is to be assessed or measured before starting the audit, and that has two things: inherent risk. I hope you remember this word, susceptibility, the possibility. What is inherent risk? See, we always explain in terms of assertion. Assertion can be misstated. Now, this assertion they are explaining in the longer definition. It can be relating to classes of transaction, account balances, or disclosures. I don't need to underline everything. That could be material. So now this word material we learn, remember, always when they explain this definition, they say, now when there is one error, I said in my early example, sale is misstated by 1 million. 1 million is one transaction, but sometimes there are several little errors, 100,000, 200,000, adding together it comes to a big amount. Therefore, in this definition, they say individually or in total. In aggregation means in total, either individually, right? Individually or collectively, right? This is individually or when aggregated. Aggregated means together, right? That is that. Then we also learn the control. Remember in my diagram that I said this is inherent risk, I said complexity change. So there is, when there is inherent risk, there is a circle protecting that. There is the control, and I said control risk is where control fails. Remember three things that I explained to you regarding control: design, implementation, and operating effectiveness. Now here control risk is misstatement. Let's say that sales cutoff example at assertion level, that could occur at assertion. Our assertion is sales cutoff, right? That is a transaction sales. That could be material, right? Then I said three things. Control may not be able to prevent, detect, and correct that cutoff error, right? So these three words you can see either individually or when aggregated, same thing, that will not be prevented, detected, and corrected. So those words you can see. And again, you will see which page number this is. So that's why I said I want you to now go and highlight this. Now don't worry about whether this is chapter 1, 2, 3, 4, irrelevant. Idea is wherever this is in the book, I know the story of auditing, and when you read, when you get into other chapters, you will fully understand. Imagine when we start doing exam questions, all these words will come. When we start writing answers, these are very, very powerful. When I do questions, you will realize how important these definitions. And then we learn materiality. Now see, especially in chapter section 5, page 140, this is your chapter 4. I said if you are talking about materiality, main thing is it can affect economic decision of the users. I mentioned to you this. Plus I said sometimes materiality you have to look at, you remember the word I said, not only size, I said by size we have to look at, that is one thing. The other one I said nature of the misstatement. Now size and nature. Now for the nature I said size is it's a big amount, 20 million. Nature means it's a 1 million or 100,000 fraud, right? And then these judgments are material for what users? We call, I said, primary users. That's the latest definition. Here we say common financial statement users. Rather than specific user group, we are talking users in general. Then the most big thing that we learned was assertions. Now remember my definition of assertion, one word to remember, representation by management, right? Representation by management. Explicit means it's written. Annual report is written that we have reported all, written, but sometimes it's not written. That is why they say otherwise. The embodied, if you look at embodied, means without this you cannot prepare, like it's in the blood kind of things, embodied in the financial statement. And why auditor are using this? To identify there's a cut-off error, valuation, etc. Type of misstatement, potential misstatement, right?